It brings together all of the narratives, all of the fundamental stories into one easily actionable, interpretable chart.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers.
Welcome back, guys, to Talking Trade. Kevin Wadsworth, my friend and partner, and I, Patrick Karim, also known as Badcharts. Today, Kevin is going to talk about, guys, don't get upset, fundamentals versus reality versus price, right? Because reality is the price charts, and we analyze the price charts. And Kevin's going to explain to you that advantage it brings to you and why. Well, I'll just let him dive into the details about what he thinks about fundamentals and how they fit in the trading framework. All right, Kevin, it's up to you, man. Convince them.
Okay, I think this one might generate quite a lot of comments, Pat, because I know people love a good story. People love narratives. People love to hear about the fundamentals and spend a lot of time getting a lot of information around the fundamental story behind whatever it is they're investing in. But what I want to do here is show you and try and prove to you scientifically, if you like, that you can kind of shortcut all of that, and you can use technical chart analysis, because technical chart analysis is, in my view, the fundamentals. The fundamentals are directly reflected by the technical price chart. I'm going to use an example, and this example applies across everything else as well. In fact, before I use this example, I'll just mention uranium to you, because uranium was something that I was very bullish about a number of years ago, back around 2019, 2020, for technical reasons. But people have been bullish on uranium for 1, 2, 3, 4 years before that. And that was because uranium had been going down and down and down post-Fukushima. And a lot of people were saying, well, it's gone down so far, the only way is up. But it went down some more for the next year. And then it went down some more. And it went down some more. And then eventually, around about 4 years or so ago, things started to turn around. What had changed? The fundamentals had been there all the time. There had been a fundamental reason why uranium should go up, why the uranium mining stocks should go up, but they hadn't. Instead, they'd fallen another 10, 20, 30, 40, 50%. The same thing applies now, actually. We've seen a bull run in the uranium stocks, and the bullish case hasn't changed. But look at what's happening in the uranium sector at the moment. It's not good. Look at what happened with lithium. There's a very bullish case for lithium and car batteries, and, there's a whole load of fundamental reasons that we were sort of inundated with why lithium was the future and lithium miners were going to go to the moon. But look at lithium prices now. They're completely dumped. So I'll use a worked example. I'm going to share my screen. Here we have a news story. This is from Barron's. Okay, and this was back in 2020. Gold prices have soared. Expect more of that in 2021. If you cast your mind back to 2019, 2020, gold had been rising steadily, rising all the way up towards $1,500, $1,600, $1,800 and more. Now, the narrative at the time, the fundamentals at the time were fantastic. There's all sorts of terrible stuff going on with the US economy and going on with in terms of debt and debt unsustainability, and a lot of fundamental reasons why there was a lot of lack of confidence out there in financial markets, and a lot of traditional fundamental narratives around why gold should go beyond $2,000, $2,500, $3,000. So what was I saying at the time? What was technical analysis saying at that time? Well, this is a chart that I put out actually a little bit earlier than that, in 2019. And this chart was, of course, the gold chart, and gold was at $1,313. Technical analysis through multiple weight of evidence techniques said that gold was going to go to $2,000, or the $2,000 area, and then was very likely to go precisely nowhere for a number of years, quite possibly bottoming sometime during sort of late 2022 or early 2023, where a cyclical low could be identified. Now, these cyclical lows are by no means precise. It's all a little bit sort of back of the envelope calculations, really. The 8-year cycle for gold isn't exactly 8 years. It's between 7 and 8.5 years. So there's a lot of leeway in these cyclical bottoms. But nevertheless, because that was there, and because we were reaching those 2,000 levels at particularly stretched metrics, it was likely that we were going to just drift down towards a low point and then resume the bull run, moving up beyond $2,500 by 2024 and into 2025. So that was my particular forecast at the time. And this was I've taken those green arrows from that chart that you can see on that chart there, and I've overlaid them on the gold chart as it was a few months ago. At the time, we were at $2,178. So those green arrows from that original forecast back in 2019 now overlaid, and you can see what the price did. It rose to that 2,000 area. It pulled back to somewhere just above $1,600, I think it was, or maybe just a bit below 1,600 for a brief while. And then off it went. And of course, we now know subsequently with hindsight that the gold price broke out, and we're now up at around about $2,400. This was the forecast that I put out around about that period in 2019. So a rise up to $2,000, a handle forming on the gold chart, then some kind of breakout taking place after that. And this is what happened. This is the technical evidence using some classical technical analysis techniques. You can see the breakout. You can see why I was bullish back in 2019, because we'd broken out above the 3-year moving average, above the Ichimoku cloud, above horizontal resistance, and we formed a bull flag. And of course, we had this geometric arc in formation, which is a bullish pattern supporting price as it rises towards its target, which was the previous highs. It reached that target, and then, of course, the consolidation period took over, and we bottomed in late 2022, early 2023, and we rose from $1,600 or thereabouts up to where we are now, around $2,400 or so. So the technical analysis is building in the evidence. It's already telling us what we need to know. The chart itself, if you think about it, is reflecting everything that's known about all of the fundamentals. I don't know, you don't know, and the experts don't know every single detail that is affecting the gold market. You'd have to know every player, every purchase. You'd have to know every fundamental driver of the gold market and everything that was likely to happen in the next few days, next few weeks. It's an impossible equation to try and put together. But with the price chart, you've got some very, very clear levels. You've got moving averages. You've got support lines. You've got all of this evidence. You've got volume support. You know where those support levels are. So when price breaks below a support level, you know that something has fundamentally changed, and you can react to that. And when price broke out here in this little purple circle around about $2,000, we knew that there was a fundamental change. We knew that this consolidation period was with a high degree of confidence, not certainty. There's never any certainty, but with a high degree of confidence, we could say that this consolidation period was coming to an end. And of course, from that, we've now moved up another $400 or so. So we use this technical analysis because it brings together all of the narratives, all of the fundamental stories into one easily actionable, interpretable chart. And that is why, in my view, you really don't need to spend a lot of time digging into the fundamentals and the narratives and reading stories in Barron's or The Economist or whichever is the publication of your choice, because you sit down with a price chart in front of you for 5 minutes and it tells you everything you need to know without you having to spend days, weeks and months researching the subject. That's my take on fundamentals versus technicals.
That reminds me, Kevin, like back in 2011, the news was super bullish for gold, right? I think the European banks were failing, a whole bunch of stuff, right? Everything is like, if you wanted a fundamental narrative or story of fundamentals, the mainstream media was lying it on a silver platter for you to gobble up, but the charts were telling you the momentum was failing down. Some rising trend lines were starting to fail in 2012, starting to underperform SPX starting to break out in its own bull era. So guys, look, either follow a little bit of the news and possibly get trapped, or just follow the chart and at least you have 100% of all the evidence. That was it, guys. Great. Follow us, subscribe for more content like this. Thank you very much. We're talking trades.